Hey, how's it going, everyone? My name is Derek Afasi. I'm the owner of Afasi Financial Group. Today's topic, I want to discuss in detail index annuities and see whether or not it may work for your specific retirement situation. Who offers fixed index annuities? Why somebody may want to get set up on either a safe accumulation play or a max income play, and then most importantly, how to understand the negatives with these types of accounts. I've seen time and time again individuals that should not be placed into a fixed index annuity, set up through other advisors, and they then call over to my office and they didn't understand the cons in depth. So index annuities could be a great product for the correct individual and could be a complete disaster for the wrong individual. So in starting out, I just want to kind of cover over the basics of an index annuity. These types of products are offered through insurance companies, and essentially what happens is you have to think of it like in the terms of a retirement bucket. You could go and someone could place their monies in variable accounts, or they could go more into fixed accounts. So it's just going to be variable, which is risky, or fixed, which is the more of the safety play. So individuals in the 80s and the 90s were able to utilize safe type accounts such as fixed annuities and bank CDs for retirement income planning. What they would do is place dollars, let's just use an example of $100,000, place it into a bank CD that's paying them 10%, and live off of that interest year by year. And let's say this is a 5-year bank CD that's paying them 10%. They would be able to say, okay, I'm gaining $10,000 each year for these next 5 years. After 5 years are done, I could take my money and place it over into the next best high rate of return, fixed account. So that's why fixed annuities and bank CDs were leveraged as laddering strategies, and it was so simple to do is you could place your dollars in there, know exactly what you're getting, and everything was very simplistic. Now, unfortunately, interest rates have gone by the wayside, and now you might have a bank CD that instead of it offering 8%, 9%, 10%, is now giving you a 5-year bank CD, might be giving you 1% if you're lucky. Or a fixed annuity, a 5-year fixed annuity might be giving you 3% if you're lucky. So all interest rates, everything's tied to interest rates when you're looking at the fixed play. So individuals are now starting to look for what could give my account more potential of growth, but still have that safety aspect, still have that aspect if the market's crashing. I understand my alternative with the variable account. If I have my money in a variable account and the market crashes, I'm going to lose all my money. With a fixed account, if you have your money in there and you have a fixed percentage rate, well, you're guaranteed that fixed percentage rate year by year. With an index, it says it's going to mimic a stock market index, saying that you're going to receive a positive credit whenever the stock market index goes up and receive 0% whenever that stock market index goes down. So it's just going to give you a more safe, consistent feature to your dollars. So if you have, 401k monies that are sitting with an old employer, or you've hit 59 and a half, you could leverage these 401k accounts, roll them over into index annuities that are set up specifically with IRA contracts. You could set this up mainly as a safe, consistent goal, saying, okay, as long as the market's going up, I'm just gaining safely and consistently with my account. Or what more times, more recently, is individuals leverage the fixed index annuities with an income rider, and this is known as a hybrid annuity, for their lifetime income goals. So what this is rather than giving you a gain when the market goes up and not losing anything whenever the market goes down, that's going to be one feature. But the secondary feature is going to provide you a lifetime income component, a lifetime income benefit that you've attached onto that fixed index annuity. One of the most important takeaways with when trying to research index annuities is you want to make sure that it's customized specifically to your goals. And let me clear off the screen. And the first example I could use is just if we have a regular index annuity without an income rider. What a person could do is, let's say if this person has $100,000, they're 55 years old, and they have an old 401k that's sitting with a previous employer, they could go take this dollars, and they understand the risk of the market. They understand the risk of mutual fund related fees, of advisor fees, downward market losses, all those different things that could hinder that $100,000 that they've saved up in their old 401k account. So this person could take the $100,000 and roll it over into a fixed index annuity set up through an IRA contract so that it's rolled over from like to like terms. It's 401k rolled over to an IRA. Now, the benefits of doing it that way is this person would receive a credit every year that that specific stock market index that they chose with that carrier goes up. So anytime the market goes up, it's as if they're opening up the lid, pouring the gain inside, and you're going to have a larger bucket than the previous year. The next year, let's say if the stock market index goes down, well, you have that safety and you have that safety net of a 0% floor. So essentially, if let's say you had a 10% cap onto that index annuity, you understand that if let's say the market gained 12% the first year and then it lost 12% and then it gained 20% and then it lost 30% and then it gained 5%, what exactly does your account look like? Well, with this type of circumstance, let's say it gained 12%, but your cap was 10, so therefore you're going to have a positive 10% that first year. So therefore your $100,000 went to $110,000. The next year, if it lost 12%, then you're going to receive a 0% gain into that account. That bucket is going to remain closed. The lid is going to remain closed. The next year, if you gain 20%, 20 is still above what your cap limit is at 10%, so therefore you're only going to gain 10% that year. The next year, if the stock market index loses 30%, well, you still have that floor of 0%. The next year, if it gains 5%, 5 is underneath the cap, so therefore you're going to gain 5% into your account. So what it's going to do is give you a very safe, consistent basis on your money to say, I just want to make sure that I have safety and consistency off of my account. Now, the downside to an index annuity is if you go and you just pick a random company, you might have seen an advertisement or you might have just had an advisor that's very limited to what options they could give you with an index annuity. That's probably the worst mistake that you could make. Reason being is because typically these things have, majority of the times, about 90% of index annuities have very low caps, and therefore the company's just leveraging your money and they're providing you with low caps. So rather than something with a 10% cap, they might give you a 3% cap. So if the market gains 12% like it did that first year, like I was explaining, you're only receiving 3% of a gain in that. The next year, if it goes down, you're only receiving 0%. So therefore, your growth potential is severely limited with that type of fixed index annuity, specific to that situation. So when you're customizing it mainly for a safe play, and this is not talking about the income play, max income planning, of just mainly the safety aspect, you want to make sure that it's in your specific area, it's specific to the dollar amount that you're looking to leverage, that you're going through a whole slew of the top carriers that have the highest cap rates and the most liquidity and the most control off of that account, meaning that you have a shorter term product, maybe a 5-year, 7-year, 10-year product, as opposed to somebody giving you a recommendation of a 16-year product or a 12-year product. There's so many pros and cons regarding these types of contracts. You just want to make sure that you're educated on whether or not it may work specific to your needs, and make sure that if an index annuity does suit your needs, that it's customized, specific to what the best options are out there. The most attractive benefits on how individuals are leveraging fixed index annuities came about a little bit after 2008, when they started attaching something known as an income rider to these types of contracts. So what that income rider does is, we understand if someone was to go and roll over $100,000 like that similar example, if they just went into a fixed index annuity, typically those types of contracts don't have any fees associated with it. Now the company is not going to be that nice. They're not just going to give you all these benefits with no cons to it. The con to those types of safe accumulation accounts is they're saying if you're in a 7-year product or a 10-year product, we're going to restrict how much money you could pull out of that account until those 10 years are up or until those 7 years are up. So they're still going to allow you to have access to your accounts. It's just going to be limited so that they could make sure that their guarantees and all of their different projections are set up and it makes the most sense for them to give you that specific offer. So there's going to be some give and take with all types of contracts. It's not just going to be, rainbows and butterflies, and unfortunately 90% of these types of products are set up very, very poorly. The 10% that are good are typically very good for an individual situation if they want to have that safe accumulation goal. If they want to, have the riskiness and they want to, make sure that they're going into these extensive types of, mutual fund accounts, and they want to have a significant growth whenever whenever the market goes up, and risk their money whenever the market goes down, an index annuity is therefore definitely not going to be beneficial for your specific goals. So you just want to make sure that you're educated on whether or not that's going to suit your needs first and foremost. Now, the second aspect that I've been honing in on is that income play. If someone goes and they have that $100,000, well, we understand if it's under a fixed index annuity, if the market goes down, well, you're going to gain a 0% into your account that year. If the market goes up, then you're going to have a growth into your account. So that's what we're leveraging, is the fixed index annuity shell, the chassis of a fixed index annuity, but the income rider comes into play because that acts as a personal pension plan. So somebody that's 55 years old and says, okay, maybe I want to trigger lifetime income at age 65, I want to correlate it to Social Security income. My $100,000, it's going to grow, flatline, grow, flatline, grow, flatline. But when it hits age 65, I could therefore trigger a lifetime income component that will provide me or me and my spouse lifetime income for the rest of our lives. God forbid if we pass away too early, whatever's remaining in your account value will go to your beneficiaries. If you guys keep living and living and living, then that company is still on the hook to pay you that lifetime income. So you could be in your 80s, 90s, hundreds, however long you guys live, that income could still be coming to you. So it works similar to how a pension plan would work, because you're attaching that lifetime income rider to that type of account. Typically, the bad aspects of an annuity are through a process known as annuitization. And what that does is, this is how annuities used to be set up when annuities first came out. It was the opposite of life insurance. Life insurance would typically cover an individual, life insurance does cover an individual from dying too soon. So what happens is, an individual would purchase a life insurance plan, they place small premium dollars every single month or every single year into a type of policy that would provide a lump sum death benefit to debt beneficiaries. If they pass away, unfortunately, then the lump sum death benefit will get paid out to their beneficiaries in a tax-free manner. With an annuity contract, a person's placing a lump sum amount with the insurance company, and now they're guaranteeing a specific amount of lifetime income payments or income payments for the rest of that person's life. So when annuities first came out, the only play that they were able to do is through annuitization to receive that lifetime income, which is typically a horrible thing, because if you have somebody that had $100,000 and they go and they place their dollars into, let's say, a immediate annuity, and they're annuitizing out their money, and this person, the company's guaranteeing them $7,000 per year off of that 100 grand, this person then surrendered the $100,000 to receive the lifetime income payments of $7,000. If they passed away after 2 years worth of payments, well, now the company's able to walk away with $86,000 of pure profit, as opposed to that person, only received $14,000 of income and their beneficiaries received nothing. So that's why the income rider came into play and has been very attractive in recent years, is because this allows the person to leverage the insurance company, have their safe accumulation happening with their physical money, leverage that lifetime income rider, that lifetime income dollar amount that would be provided for either them or them and their spouse for the rest of their lives. And if they pass away too soon, then whatever's remaining in their account value would go to their beneficiaries. If, let's say, they keep living and living and living, this account value is being depleted each time that a withdrawal is being made for that lifetime income. So if someone had $100,000 and they're pulling out $10,000 because that was the guarantee from the insurance company, well, and let's say the market didn't gain anything, well, then $10,000 would keep coming out of that account value. So after 2 years, let's say, God forbid, that person passes away, $80,000 would go to the beneficiaries in that simplistic example. Let's say if this person keeps living and living and living, and let's say they lived 20 years and then passed away, well, their break-even point would have been 10 years, because 10,000 times 10 years is 100 grand, and they would have received $100,000 more of profit because they kept living and living and living. So that's where the customization comes into play, and you really has to hit home, is understanding that these carriers have certain niche criteria. Depending upon your area and depending upon how much dollars you're looking to leverage and receive for lifetime income, there's going to be a whole slew of different carriers out there specific to your needs. If you're looking mainly for a safe accumulation play, you could have 3 separate carriers, for depending upon your age, as opposed to the next guy that's 2 years older than you. With their safe accumulation play. If you're looking for a max income plan, that is the most important way to make sure that you're leveraging the customization of these types of plans. With your area, with the dollar amount, you might have, let's say if you're 55 years old and you're looking to trigger lifetime income at age 62, you have over 300 different companies that offer product lines, and then each company has about 3 to 5 different variations of this type of fixed index annuity with an income rider or fixed index annuity. And then on top of it, you have multiple strategies. So one of the things that we have and makes us unique is we have something in-house known as the Retire Sharp Planning System, where anybody that's interested in an index annuity or a retirement income goal, they would go call our office, our 1-800 number, 1-800-566-1002, and they'll deal with a specialist. From there, that specialist is going to educate them and see whether or not an index annuity makes sense. There's many times when it doesn't make sense for an individual situation. They might want to have too much growth into their accounts, or they might want to risk their monies too much, where it's just not going to correlate to the risk. It's going to be more of a safe, consistent. This is meant for the person that wants to have more of that safe, consistent mindset, and also provide those very safe lifetime income guarantees through insurance companies. So there's going to be a whole slew of different carriers. On average, for each person that calls into our office, we go through over 1,200 different contract scenarios and strategies before we recommend our top 3 results. So we might say, okay, option A might be the best recommendation, and these are the pros, these are the cons, as opposed to company B and company C, and this is why we're recommending company A. So you just want to make sure that's customized at all times, that it's specific exactly to your plan, and you're not just going into a random company because you saw an advertisement, you saw some marketing advertisement, or in a newspaper, wherever the case may be, over your television. So you want to make sure it correlates directly to you. The whole premise of you placing your money into these plans is you want to throw your dollars into something that's safe, that's going to provide you a specific benefit, whether that benefit is for the safe accumulation or that benefit is for max income. It has to make sense for your particular situation. If it doesn't make sense, there's no reason going into those types of plans. The other aspect is the insurance company. These insurance companies are in the business to make money. They're going to try to use your money to then make money on the back end. So there are certain gaps with these insurance companies where they have excellent plans for a particular individual situation. Once again, somebody that's in their 60s is going to have a whole slew of different top plans than somebody in their 50s. Somebody in their 70s is going to have a whole different slew of top plans than somebody in their 60s. So, you just have to understand what are the pros, what are the cons with these sorts of things. Make sure it's customized at all times. Make sure that you're leveraging the safety aspect versus the risky aspect for retirement, and then you're also understanding the negatives. This is one of the things that we try to hone in on. This is why I always try to, create this free content every single day, every single week, is to try to educate as many people as possible with what is possible, for your retirement, and making sure that you're eliminating any sorts of mistakes. You have to look at retirement as your livelihood, as if you're getting on a plane that has a 80% chance, 90% chance of crashing. You want to have pure certainty in retirement, and that's one of the things that we try to help individuals out with. We are A+ rated on the Better Business Bureau. We've always had very good reviews. We've never had any complaints, and it's because of our methodical process. I want to thank you very much for watching this video. Please make sure to subscribe to our YouTube channel, Retire Sharp, so you could have access to the most updated videos. Thanks so much, guys. Hope you enjoyed.